start off this class. I hope you guys had a wonderful day today. So this is what we're supposed to cover tonight. Module 27, we're supposed to cover futures trading. And under this, we're going to look at what is futures trading, the difference between USD-M futures and CoinM futures. Then we're going to have a definition of terms, basically terms that are commonly used in futures trading. Then lastly, we're going to have a full guide. No, okay, actually this full guide on Binance, we're going to do that tomorrow. So today we're going to basically have introduction to futures trading and learn the basics of futures trading. Before we even start with futures trading, who can tell us or can remind us what spot trading is? Spot trading. What is spot trading? Who can remind us what spot trading is? Sly?
So spot trading is where you buy a coin, an asset. You buy an asset at a lower or subsidized price, and then you hold it and sell it at a higher price. So,
Yes.
but now sometimes you can buy it at a lower price, and then maybe when it depreciates in value, then it means that your coin has lost value. So the amount still remains the same, but the amount of coins remains the same, but the value goes down. So it means that you have to hold it, be patient until it goes up again, and then you sell it. But you can never buy high and sell low. Like, you cannot make profits by that. You only make profits by buying it low and then holding and selling it when it's at a higher price.
Yes, that was a perfect explanation. I can't even add anything to that. Let's appreciate Sly. Yes, so basically that is what spot trading is. Spot trading is a scenario where you only make money when the market is going up. And also we said that if you've bought an asset and the price goes down, the number of tokens that you have will remain the same, or the number of coins that you have will remain the same, but the value of that token is what goes down. And I remember we said a term like the tokens becomes, or your investment becomes worth less and not worthless. So let's look at what futures trading is. Futures trading is when you agree to buy or sell. Remember, in spot trading, you only make money when the market is going up, but in futures trading, you agree to buy or sell an asset like Bitcoin at a specific price and time in the future. So you don't actually need to own the Bitcoin. You are just predicting whether the price will go up and down. So, and you earn or lose based on that prediction. So if you had predicted that price is gonna go up and actually the price goes up, then you make money. But if you had predicted the price is gonna go down and it actually goes up, you lose, and vice versa. So if you've predicted the price is gonna go down and it actually goes down, you make money. If you had predicted it's gonna go down and it goes up, then you lose your money. So an example, you think Bitcoin will go up, you open a buy. And remember we said the buy means long. And in short, long means the price is gonna go up. So you open a buy on futures trade at $60,000. So if BTC rises to 62, you make profit, even if you didn't own any BTC. So in short, or rather in layman's terms, you can say in spot trading, you only make money when the price is going up. But in futures trading, you can make money when the price is going up, or you can also make money when the price is going down. The inverse is the same. You can lose money when the price is going up, and you can also lose money when the price is going down, because this solely depends on your prediction. So let's have there are other terms. You find other exchanges calling futures trading derivatives or perpetual. But let's have a dive in of what derivative is. A derivative is a financial product that gets its value from something like Bitcoin, Ethereum, or even gold. So futures is an example of a derivative. No wonder you'll find other exchanges, for example, an exchange like Maxim will actually call futures trading derivative. So if you see derivative from your favorite exchanges, do not worry to think what that means. Just know it means futures. Also perpetual is a type of futures contract. So perpetual, these are futures that do not expire. You can keep the trade open as long as you want, as long as you have enough margin. We look at what margin is in a few. You pay a small fee called the funding fee. Rather, funding fee is the amount an exchange is charging you for offering you a futures trading option. So depending on whether you are buying or selling. So if you go to your favorite exchanges and you find that they are calling, you're not finding a segment known as futures. If you see derivatives or if you see perpetual, know that is one and the same thing. They mean the futures trading. So let's have a definition of terms before people get confused when you say long, when you say short. Let's define some specific terms, which is long, short, or buy and sell. So when you trade futures, you are not just buying. You can bet both ways. Remember I said you make money or lose money depending on your prediction. So you can make or lose money when the price is going up, and you can also make or lose money when the price is actually going down. So let's look at long position. If you see someone saying go long the market, go buy the market, what do they mean? So in a long position or in a buy position, you expect the price to go up. The price to go up. That's the definition of a buy position. You expect the price to go up. And if it does, you profit. But if it goes down, then you lose. An example, you long BTC at 60,000 and BTC goes to 65. You profit. But if BTC goes down to a value less than this 60,000, then you lose. So a long position, you expect the price to go up. So if the market actually goes up, you profit. If it goes down, then you lose. A short position a short position is the inverse now of a long position. A short position is what people will also call a sell. So in a sell, you expect the price to go down. The price to go down. And if it does, you profit. And if it goes up, you lose. So example, you short BTC at $60,000. So if BTC drops to 55,000, you profit. But if it goes to a price higher than this $60,000, then you are in losses. A short position tool, a sell, you expect the price to go down. So an easy way to remember this is just know a long means buy, and it also means bullish, and it means you believe the price is gonna go up. A short position, however, means you are selling the market, meaning that you expect the price to go down, which is what we call bearish. I hope that is clear up to that point. So if you go to Binance, this is the Binance exchange. If you want to navigate yourself to the futures option, let me just go back. What you do, if you want to navigate to the futures option, just go to this part right here. If you can see that thumbs up, this part right here. Remember, when you're navigating to the spot market, what you do, come to the trade segment, then go to the spot market. But in futures, this is where you get to choose futures. So if you come to this part right here, you'll see Binance offers two types of futures, or many exchanges. Remember, I'm teaching using Binance, but the same demographics will repeat themselves in other exchanges. So you'll go to exchange, you'll find there's USD-M futures and the Coin M futures. Let's look at the difference between the two of that. So the difference between USD-M and coin M futures. So in USD-M futures, it is a stable coin margin. So when I say stable coin margin, I mean you use stable coin like USDT or BUSD as collateral. So most of the pairs or the trading pair, remember when you're talking about trading pair, we had two types. We had the base currency and the quote currency. So in USD-M, the quote currency is USDT, a stable asset, USDT or BUSD. But in most cases, or all the times, mostly, you use the USDT. So our quote currency is what? USDT. So when you use USD-M futures, you earn or lose in USDT or BUSD. I want to delete this so that it can be easier because we'll be using USDT either way. So in this case, you earn and lose in USDT. So if you've entered a long position in your buying BTC and you make profit, your profit will be settled in USDT. The profit you'll have in your wallet, it will be settled in USDT. So it is best for people who want profits in stable coins. Then it is easier to manage risk and beginner. So example, if you open BTC USDT, your profit or your loss is in USDT. So if you lose your value in USDT, and if you make profit, you make your profit in USDT. And it's very easy because it's easy to know the amount you're making or the value you're making or you're losing because USDT is pegged to the dollar. So you can easily convert, or you can easily know. It's easy to say I'm at a loss of 30 USDT than saying I'm at a loss of 0.0000124 BTC. So the easiest way for even your understanding is the value being in USDT. So no wonder most people use this option, USD-M futures. But what is coin M futures? It is crypto margined. Now we'll have our pairs being something like BTC/Ethereum. Remember in USD-M, our pairs, our currency pairs is like BTC/USDT. But in coin M futures, an example is BTC/Ethereum. So you use crypto itself as a collateral. If Ethereum is your collateral, if Ethereum is your quote currency, then that Ethereum will be your collateral. If BTC is your quote currency, then BTC will be your collateral. Your profit and losses are in the crypto you are trading. Let's assume Ethereum is our quote currency. So our profit and losses will be in Ethereum. If I've made money, it will tell me I've made 0.00124 Ethereum. If I've lost money, it will tell me that I've lost 0.00012 Ethereum. So in short, my profit and loss will be settled in Ethereum. So it is best for experienced traders who want to grow their crypto stack. And example, you open BTC USD-M using BTC, profit and loss will be in BTC. So that's the major difference between the two. So, and we have said in our case, we'll use what? We'll use USD-M futures. Like that. We want our base, our quote currency to be USDT, and we also want our P&L, or rather profit and loss, to be settled in USDT. So before I even navigate to that part, I want us to discuss some terms that are very, very important in futures. So these are very important, and I need us to understand this in depth. So understanding key features, futures trading terms. Number one, we will have what we call margin. So margin is the amount of your own money that you put down to open a futures trade. In short, your capital, the capital that you're putting into your futures wallet. Remember, in spot wallet, if you want to trade the spot market, remember we have different types of wallets. We have the we have the futures wallet, we have the coin M futures, we have the fiat and spot, the margin and all that. So if you want to buy coins on the spot market, your fiat and spot wallet should have money. If you are the USDM futures, then you should also transfer it. For example, if your money is in the fiat and spot, then you need to transfer your money from the fiat and spot to the USDM futures. But we'll look at that tomorrow. Today we're just having an overview of how the futures platform looks like and some definition of important terms. So number one, margin. In simpler terms, margin is the capital, the amount of money you put down to open a futures trade. Margin is the money you put in to open a trade. The easiest way to remember this, just remember margin is your capital. Then you have what you call size. Size, this is the total value of your trade, including your money. Remember, including your money. So in short, including margin, because margin is your money, your capital. So this is the total value of trade, including your capital or your margin and borrowed money from leverage. So example, you use $20. $20 is your capital, or rather your margin, with a 5x leverage. We look at leverage right now. Then your position size is now 100. So in short, size is equals to margin times what? Margin times leverage. And I think at this point is where we're going to discuss leverage first of all, before we even move to anything else. So let's look at what leverage is. Leverage lets you borrow money from the exchange, for example, Binance, to make bigger trades with a small amount of money. A small amount of your money. So let's have an example. You have $10. $10 is your margin, or rather your capital, or rather the amount that you're committing to that trade. Your own money that you're committed to that trade is $10. But your wish is to trade with $100. So for your account size to be $100, what do? You borrow from Binance. You tell Binance, I want to open a position worth $100, but I only have $10. So what leverage will you use for your account to be $100? 10x. So if you multiply, you've borrowed 10x leverage means you've borrowed money from Binance for your account size to be $100 and not $10. So, and you should also remember, high leverage is equals to bigger potential profits. No wonder people depend on leverage, because it will allow you to open a bigger sized account, and that informs that your profits will be more. In comparison to if you had not borrowed and you're trading with only $10, then your profit will be less. But with a bigger account size, then bigger potential profit. But also remember, the more leverage you use, the bigger potential of losses you have. So 10x, 50x, a person who is using 10x, the risk is lesser than a person who has borrowed 50x from Binance. So how does margin affect your trades when you're using leverage? So let's have an example in a scenario when you're talking about a profitable trade. Before I even move to that, if you have understood what leverage is, thumbs up. Or if you have any question on leverage. If you have a question on leverage, if you have understood what leverage is, thumbs up. Perfect. So how margin affects your trade when you're using leverage. So let's look at a profitable trade example. So let's say your pair is Ethereum USDT. Your margin, remember you said margin means capital, the amount that you yourself has put into that trade. So your capital is $80, but your leverage is 5x. So what this allows you to do is, it allows you to open a position that is worth $400, but the only amount that you've committed, that is your own, that you've committed to that specific trade, is only $80. So remember, you said size is equals to margin times leverage. No wonder our size right here is $400. 80 times our leverage, our capital times our leverage, 400. So trade direction, we are predicting that the price of this asset, Ethereum, is gonna go up. So we are longing. So our entry price is 2,000. And then Ethereum rises by 4%. So the new price is 2080. So let's look at how margin will help us increase our profit. So since Ethereum went up by 4% and our leverage is 5x, your position gains 4 times 5. So 20%. 20%. Now your profit, if you did not use leverage and you had only $80, your percentage profit will only be this 4% that Ethereum rose with. But since you've borrowed or you've used a leverage of 5x, then your profit will will go up by 5%. So your total profit will be 20%. So 20% of the $80 that you've committed, that will be $16. So the final outcome will be now $96, but the actual profit will be $16 profit. That's the case scenario of advantage of using leverage in a profitable trade. But also remember, I've said the more leverage you use, the more riskier it is. So it means if this market went down, then our loss will also be the same. It will be 4%. If it was negative 4%, it then means now it's 4% multiplied by our leverage. So our loss will also be negative 20%. In comparison, if you're not using leverage, your loss will only be negative 4%. But since you're using a leverage of 5%, then it means our loss also will be that 4% multiplied by our leverage, which is negative 20%. So let's look at that. Let's see an example right here. So in a losing trade, we are having our pair Solana USDT. Our margin is $80. Our margin, remember we said margin is the capital that you yourself has put into that trade, your own money. Then leverage is $5. So our trade size will be, remember I said size is equals to margin times leverage. So it will be 80 times 5, which is $400. Our direction is long, but Solana actually dropped. So we are in losses because our prediction was that Solana will long or Solana will buy, or so the price of Solana will go up. But what actually ended up happening is Solana dropped by 4%. So the new price is 96. Remember our entry was $100. So the new price is 96. So what happens in the 4% drop? The same as the profit, we now need to multiply our loss with our leverage. That 4% multiplied by our leverage 5x, then our loss will be negative 20. And negative 20 of our capital is $16. So you will have made a loss of $16. No wonder we are saying leverage has an advantage and also a disadvantage. The more leverage you use, the more money you'll make. And also the inverse is the same. If that trade goes against you, or rather it's a losing trade, the same repercussions will also be there. High leverage, high risk. High leverage, high reward. So yeah, so that's basically all about leverage. So how does leverage affect trades? Higher leverage will allow you to open a bigger position, but more risk. So you can lose your money faster if the price goes against you. Even with a small price movement of -1 can liquidate your position if you're using a very high leverage of 100% or 50%. So let's look at what liquidation is, because you have mentioned liquidation, liquidate your position. Who can tell us, we said you can only lose money in spot when you do what? What's the only way you can lose in spot? In spot trading. And I remember that's why we said is the safest way to trade. How do you lose in spot? Someone? Eli?
By selling.
Yes. Let's appreciate Eli. Yes, in spot trading, you only lose once you sell. is spot. What I said is the safest way, because you can never get liquidated, because you still remain with your number of assets, but the value is what goes down. So you can decide to be patient enough and wait for the price to go up and recover your losses. But in futures, we talk about liquidation. What do we mean by liquidation? Liquidation, this is a price level where your margin, remember, margin is your capital. So when your margin is fully used up and the exchange forcefully closes your trade to avoid bigger losses. But in short, it doesn't even make sense to say bigger losses, because it basically wipes you off. So let's say you had opened a position, this example right here, a position $80, and the market actually, you had longed, so you expected the price of Solana to go up. But what happens is Solana goes down. If Solana continues to go down completely and you had not set a stop loss is a price at which you'll cut down your losses. So if you do not have a stop loss and Solana continues to go down, what will happen is it will continue to eat up on your, on your margin. And once it has eaten all up your margin, that position will be closed forcefully and you will have lost that money completely, like zero. Your amount, your account balance will be zero. That's the meaning of liquidation, and it sends a message like this. If you can see this Mina perpetual liquidation sell, this means you are liquidated, and the amount that was wiped off from this position was actually $96. So this $96 was fully consumed by the exchange. So that's the meaning of liquidation. The price level where your margin is fully used up and the exchange forcefully closes your trade to avoid bigger losses. So example, you open a long of BTC at $60,000 using 20x leverage. Your liquidation price might be around 57,500. So what this means is once price reaches 57,500, if BTC goes down to 57,500, then all your amount that you had committed, all the margin that you've committed in this position will be consumed by the exchange. If you've gotten the concept of liquidation, thumbs up. Liquidation. If that concept has been understood, perfect. So how then do we avoid liquidation? Number one, use low leverage. Remember you said higher leverage, it's right here. Higher leverage, higher position or bigger position, but more risk. So if you want to reduce liquidation or to avoid liquidation, number one, use low leverage. It's safer and gives your trade more breathing room. Number two, set a stop loss. I repeat that again, set a stop loss. So this closes your trade early to prevent big losses. Number three, DCA, dollar cost averaging. I know we had talked about DCA in buy and hold, or rather in spot, but also we'll discuss about DCA when it comes to spot trading, to futures trading. So dollar cost averaging means add to your position slowly, not all at once. But we'll look at that tomorrow. Then you have add margin, boost your available funds to reduce the liquidation risk. We'll also look at this practically tomorrow. So coming back, I think we were here, we were talking about size. Now coming back to this, it's easier to understand what size is now, because now we know what margin is. Margin is the capital, and you know what leverage is, borrowed capital. So in short, size is margin multiplied by the leverage. Let's go to ROE. ROE, return on investment, or something like that. So it shows how much profit or loss you've made compared to your margin, your own money, the money that you had put in, not inclusive with the borrowed money, the percentage profit or loss that you've made in comparison to what? To your capital or your margin. So example, if you use $50 as your margin, you make $10 profit, then your ROE will be 20%. And it actually looks like this. If you've seen people sharing things like this, 63%. So it means I've made 63% ROE in comparison to the margin that I had committed to. If you can see that, thumbs up, percentage, this percentage right here. And the inverse is the same. When it comes to a loss, this was a loss trade. So the loss, the percentage, this percentage right here is what we call the ROE. So the percentage loss that you've made is in comparison to what you had invested, or rather you had committed to that particular trade, the margin. So the ROE is a percentage profit or loss in comparison to your margin. Let's talk about the P&L. P&L is profit and loss. P&L shows out how much money you've made or lost in a trade. How much money you've made or lost in a trade. Let me show you an here. How much money you've made or lost in a trade. For example, if you come to this trade right here, you'll see P&L. If you can see that right here, P&L, thumbs up. I want to make sure it's visible. So this P&L 757.37 actually means that the profit that was made on this particular trade is $757. 757 USDT. Remember, you're on the USD-M futures. So our quote currency USDT. So our profit is also settled in USDT. So the amount, you can see P&L, then into bracket USDT. So the amount of money that you've made is $757. And your ROI, return on investment, remember you said is the percentage profit or loss that you've made in comparison to your margin right here. Here it is. So, and if you look at the components of this trade, you can see, if you can see isolated, let me try and zoom out. Zoom in, I mean. So let me zoom in like that so that you can see something here. I want us to see something. What's happening? Like that. Like that. So if you see, you can see that our leverage right here is 15x, but our margin was 608. So what is our size, someone? Our leverage is 15x. Our size is 608. What's our margin? Pius?
Will be 15 multiplied by 608.85.
Yes, when you multiply that, what do you get? Let me just multiply on my end. 608 multiplied by 15. It's 9120. 9120. 608.85. Yes, 9132. 9132 is the size of that position. But why do you think this size right here is a value that's not that? Someone? Why do you think? It's supposed to be 9132. Sly?
Because that value means that that's your profit.
Not this one right here. This one under size. Remember I said the size is margin times leverage. But you can see if you multiply 608 by 15x, the value is 9132. But right here, the size that had been indicated is 5492.
Maybe because you DCA'd.
Yes. Perfect. You've actually committed, you've actually brought something else that I had not thought of. But the first thing is, let me just start with what you had said. If you had DCA'd that trade, it would affect your margin and everything, and your size also. But also something else, if this position was long overdue here on Binance, or rather it has stayed on Binance for a long time, you'll notice that your margin and also your size will reduce because of the charging fees or the trading. Is it trading fees? Yeah, that's the correct term to say. Yes, the trading fees.
Okay, I didn't know that it is normally charged.
Yes, you get charged. or also if you DCA'd or if you added margin. If you add margin, it would affect your size, and if you DCA, it will also affect your size. But do not worry, we'll do that practically tomorrow.
So 608 is the money that you deposited, like your actual cash at hand, right?
Yes, this is the amount that is in that position, your capital, in short.
Okay.
But now you borrowed an extra 15x to top up your size, to increase your size. Is that okay? Perfect.
Yes, it's okay. Thank you.
Then this is your entry price. Our position looks like this. Your entry price is right here. Your market price. Mark price is basically market price, the current market price. So you had predicted this price will go, this coin will go up. It was a long position. So if your entry price was 1.69 and your current market price is 1.96, then you're in profit because price has gone up. But your liquidation price is 1.488. What do you think will happen if virtual actually went down to this liquidation price? Someone? We've talked about that right now. Liquidation price is this. So what would happen if the price of virtual actually did not go up to 1.96, but rather it went down to 1.488? This liquidation price right here. Joseph?
You lose all your money.
Yes, we lose all our money. So it means our margin balance will be what, Joseph?
0.00.
Yes, 0.00. So if actually virtual went against us and it went to this liquidation price, then we lose all our money. The $608 will be consumed by Binance in this case. Sly, you have a question?
No, I want to add something. And then also P&L will be negative.
Yes,
It will be where the 757 there will be a negative figure showing the losses.
Yes, it will be our ROI also percentage will be in the negatives. Let's appreciate Sly and Joseph. Great. Sly, you have another question or a point? You can see your hand is up.
It was by mistake.
Okay, perfect. So that's how basically how let me zoom in. That's how a position looks like. But we'll do that in due time tomorrow. So, and that's what we are talking about. If you want to avoid liquidation, you use low leverage, you set a stop loss, you DCA, or you add your margin. Let me look if there's something I've jumped. We've talked about profit and loss leverage. Perfect. So, how do we then get to calculate leverage? If you've done futures before, you just don't guess a leverage or a size. Let me just show you where you input that. So this is basically futures. The futures are set up, but I want us to dive into that more practically tomorrow. But just to mention, this is how futures look like, and you've seen how we navigate ourselves to this part on the Binance exchange. Remember, go to futures, then under futures, choose the USDM futures option because we want our quote currency to be USDT, or rather we want our profit and loss to be settled in USDT. So from the top left right here, this is where you get to choose the token you want. If you want AVAX USDT, this is where you come and choose. If you want to choose maybe BTC USDT, this is also where you come and input that and choose that. You can see perpetual. We've said if an exchange calls it perpetual or calls it derivative, they mean the same. It means futures. So just come and choose here. And now your settings will be, your coin of choice will be BTC USDT. Great. So this is basically TradingView. We talked about TradingView. You can come and use TradingView from Binance, or also you can go, the easiest way is to use TradingView itself, the separate platform that specifically deals with charts alone. So yeah, that. Then right here we have an order book. Who can tell us what an order book is? We talked about an order book. An order book. How did you define an order book as? An order book. Even if you can't remember the terms, full terms, there's a word we said. Pius?
Pending.
Pending, exactly. So when you say pending, it means this is where all pending orders are kept. pending, not executed, pending. So all your pending orders in a particular trade, this is where they go in the order book. So the most important part is right here. Right here, this left, not left, right, this right part right here. So if you come at the top right here, you'll notice there are conditions that we need to set for our setup for our trade. There are conditions that we need to set. So you'll notice if I come to this part right here, I have two options. I can choose cross if I want my margin mode. Yes, it's called that's the word I was looking for. Margin mode. There are two types of margin mode. I can use cross or isolated. Let's look at what we mean by that before we even move to anything else. What do we mean by cross and isolated margin? Two margin modes, cross and isolated. Let's start with cross. Under cross margin uses all your available balance in your futures account. Remember I said if you want to trade, what you do, transfer your money. Remember, you have different types of wallets. We have fiat and spot, coin, and whatever. All these are different types of wallets. So if you want to trade the futures market, you have to transfer your money to this wallet right here. So under this, cross margin, it means Binance, or rather your exchange, uses all your available balance in your futures account to support your open position. So if one trade starts losing, your whole account balance can be used to keep it open. So it's more riskier. But with isolated margin, you use your specific amount for one trade. So what do we mean by this? Let me maybe go to a chart. What we mean by this is, for example, in a trade, my whole margin account, not margin, my whole why is this too small like this? Let's say my whole futures account. Remember, my futures account, where all my money is for trading, futures account has $1,000, 1,000 USDT. So that's the amount that is in my futures account, 1,000 USDT. But I want to enter an AVAX setup. I want to enter an AVAX setup with what? I don't want to use my whole amount. So the margin that I want to enter this setup with, remember we said margin is capital. So the capital that I'm willing to commit to the AVAX setup is how much? 200 USDT. 200 USDT. So with isolated margin, the only amount Binance will only isolate my amount. Will isolate $200 from my 1,000 USDT. So even if I am in losses, I get liquidated, I'll only get liquidated this isolated 200 USDT. From the word itself, isolated margin, it has isolated 200 USDT from my futures account. So even if I go and I get liquidated, I'll only lose this 200 USDT, and my account will remain with what? With 800 USDT. But with the cross margin, it means that Binance, in short, I've given Binance the mandate to use the amount in my futures wallet. So, or my futures wallet or my futures account, whatever you want to call it. So, if AVAX goes to $200, what will Binance do? It will automatically, remember we said a way to reduce liquidation is actually add margin. So what Binance will do, it will because I've chosen cross, it will automatically assume, or rather I've given it mandate to add margin automatically. So what it will do, if my 200 is almost getting liquidated, it will add margin from my 800 USDT that is remaining in my wallet. So it means if the AVAX goes down until all my margin has been used up, this 800 USDT has been used up, I lose that full amount. So in futures trade, in cross margin, I'll lose the whole amount. It is not isolated to that specific trade. I lose the full amount that is in my futures wallet. So basically, I lose the whole 1,000 USDT. But in isolated, I only lose the amount that I've committed. It is isolated from my futures wallet. The only amount that I lose is the money that I've committed to that specific trade. So that's the difference between that cross margin and isolated. With isolated margin, you only use a specific amount for one trade. If that trade goes wrong, only that amount that you isolated for that specific trade will be at risk, not your whole account. But in cross margin, your whole account. So it's best for beginner, and it is good to control, or rather easier to control the risk. So coming back to this is where then you come and choose that. I will highly advise to use isolated margin, and you do that right there. Then you have the margin, the leverage. This is where you get to choose your leverage. Leverage, you can see we have all the way to 125x. So this is where you get to choose the leverage that you are willing to use. But before you even do that, this thing I want us to do tomorrow, before you even do that, I want us to know how we then calculate leverage. We just don't use any leverage, but there's a formula that we use to calculate our leverage. So let's start. Leverage is equals to percentage risk divided by the standard loss. And someone will ask me, what is percentage risk? What is standard loss? Let me just navigate myself to this setup right here. Percentage risk divided by standard loss. Let me write it here. So leverage, I want where the position is. Let me use a setup that has been triggered already. Yes, this one. So leverage is, let me just write here. So leverage. If my screen is visible, kindly, so that I can know if I can enlarge. Leverage is equals to percentage risk divided by standard loss, like that. Is it visible? I increase it. If it is visible now, thumbs up. Yes, so leverage is percentage risk divided by standard loss. So let's do it right now. What is percentage risk? Remember, this is our position tool. Let me just start by naming this part. This is our position tool. I've done my analysis, the VET USDT. Actually, I've been triggered into that trade. It's the VET USDT. So the VET USDT, this is my position. This is my position right here. So what happens is my entry is right here. My entry price is here. Let me even name this part. Here's my entry. This part right here is my entry. My stop loss is at the end of this red zone. So that's where my stop loss is. SL. My SL is right here. And my take profit is at the top right here. This is my take profit. Those are the first things that you need to know. So after knowing that, I have my entry. So when I go to my Binance, if I'm taking this position, what I'm saying is I'll go to Binance and I'll say, let me just zoom so that you can see this entry, stop loss, and all that. So here's my entry. So it means my entry is 0.0299 something. If you can see that, thumbs up. This one right here. This is my entry. If you can see that, thumbs up. So that's the first thing you do. Come to Binance, your entry. Remember we talked about market order types. Are we going to use market order? When you use market, we talked about this. There's no need for me to repeat. If I say market, it means I'm entering that position with the current market price. But I don't want to enter this position with the current market price. I want to enter this position with what? 0.02229. So what I'll do, I'll use limit. Why are we using a limit, a buy limit? Let me go to this so that you can see. Why am I using a buy limit? We talked about this. Sly, why are we using a buy limit?
Okay, we're using a buy limit so that probably the entry point, you see, like now, let's say, for example, you hadn't taken this, you've missed that entry point. You want to get at that entry point. So you can't put market price, because if you put market price, it means that it will enter at 0.003. So if you put a stop limit and you put it at the price where the entry point is at 0.029 something, then when you put a limit, means that when those candles come down and touch there, then that means that it will be activated. So if you put a market price, it will buy at where the green is, the last candle is. But when you put at entry point, means that you wanted to come back down there and pick it up. So it's do an order.
Yes. Let's appreciate Sly. But I repeat that in simpler terms. You're actually very correct. So basically, what a buy limit is telling me to do, or rather what we define a buy limit as, it's an order type that allows you to buy an asset at a price lower than the current market price. Lower. Remember, the current market price is up here, but I want to enter this trade at this point. I want to send you how this trade was looking like during the day. Is it vet, so that you can easily understand, because right now it has been triggered. When I was entering this trade, the price was up here. So I did set a buy limit so that when it comes down to this zone, it will trigger me into that trade. And you can see it went down to that trade there. Let me just navigate. I had taken a screenshot.
Wanjigo, I'm just wondering, so why did you put your by long tool there? Like, did you use an FVG or did you use a block? What do you call these things? A block bearish.
I have sent. Okay, let me just show you. This is how it was looking during the day. I've sent that screenshot in the group. If you can navigate to your phones and that the group, you can see it was a trade that I took at 145. You can see right here from the top right here, it was 145 today. So this is basically what I used. My take profit was predominant. Let me just go to that chart. My take profit, the determinant of my take profit, this is what we call a trend line liquidity. So the determinant of my take profit was this week, 50% of this week. If you can see that slide, so you can see that.
Yes.
50% of that week is what is my take profit. The reason why I decided this price is going to go up is because of this trend line liquidity, and I expect the market to collect that trend line liquidity. But why I took this place right here, remember my setup, this part wasn't there. Let me see if these things actually work. This replay, my setup was up to that part. You can see.
Yeah.
It was up to that part like that. If you can see that screenshot that I've sent into the group, it was up to that part. So my reasoning was, if you see from that zone, there's an FVG. You can see that?
Yeah.
So you can see there's an FVG. These three candles following each other, there's an FVG.
Yeah.
Yes. And on top of that FVG, there's a last green candle before a significant sell.
Yeah.
The doji-like candle. This one. Let me just release this one. This doji. Remember, this is what I'm talking about. I'm having an FVG right here. That one. I changed my colors because I hate seeing these things on my chart boldly. They confuse me, but let me just put that boldly so that you can see. You can see that.
Yeah.
Yes, we have an FVG. Then another confluence is, no wonder I hate having all of this. No wonder I deleted all of them. The only thing I remained with is this line to show me where my entry is. So I have an FVG right there. Then I also have my last doji candle right here, my last green before that sale. You can see that. So that's my second confluence. My third confluence is we're in an uptrend, a series of what? Remember you said a series of higher highs and higher lows. So I'm timing this market and it's coming down to form a higher low. Yes, a higher low, a low that is higher than this previous low. Then I'll be tapped into that setup and I'll go with it. Is that okay now?
Yes.
Yes, but I love to delete all of this because I find them confusing me in the chart. So what I do, I'll get my POIs. After getting my POIs, I just use a line. You can see I just have a green line to show that, so that my chart can be neat and not confusing. So that's basically what I did. Nothing much. So we have our SL. What was I talking about? How to calculate leverage. So we have our entry, we have our SL, and we have our take profit. So I was basically covering these parts. So we know our entry. Remember which setup was this? This was VET. So the number one thing you need to come and do is choose here, top left, top right, top left actually, VET USDT, like that. VET USDT. Then the second thing you need to come is choose the isolated margin, and you have looked at the advantages of using isolated margin. Then number 3 is the leverage, but skip on the leverage. We are gonna know how to calculate leverage in a few. The price, remember I'm buying this asset at a price lower than the current market price. You can see that the price at which I was entering, the current market price was up here, but I wanted it to come down into this zone. So a price lower than the current market price, so I'll use a buy limit. So I'll come to my exchange and use the buy limit. You can see I've chosen the limit. Then I'll enter that price, my entry. My entry, where's my entry? My entry was around, let me just go to this so that you can see, 0.2999. So 0.02999, like that. So, and my size, now my size, I can use this crossfader and say 100% or 50% of my account or 100. So if my account has $100, what will be my size? It will be $100 times my 5. Remember, size is leverage times margin. So here will be my size times the leverage. But ignore that, we'll do that in a few. Then take profit, my take profit price will be, this is my zone of TP, it will be 0.032. So that's what I write here, 0.032 and some numbers. Let me just guess for the purpose of demonstration. Then my stop loss will be this price right here, this price at the bottom right here. Let me just use a line so that you can see it like that. So my stop loss is 0.0299. So 0.029, whatever. 0.0299. 0.0299, whatever. So what it means is, if my position goes down, if VET actually doesn't go up, let me start with the profit. If VET, you can see the current market price of VET is 30.54. If it goes up to 32.56, I'll collect my profit at that juncture. And if it reverses and goes down, I'll be stopped out at this price, just as demonstrated with this chart right here. If if VET goes beyond this red zone, I'll be stopped out using my SL condition that I've set. But if it goes to my take profit, then I'll collect my profit at that particular price. So let's know how do we calculate risk, leverage, I mean. So we are saying leverage is equals to percentage risk divided by standard loss. So what is percentage risk? Percentage risk is the amount of money you're willing to lose at a particular setup. So for example, if my account, my margin, remember you said margin is what? We have said margin is the capital or the amount that you're willing, your own money that you're willing to put into that account. So if my capital is $100, my percentage risk is the amount that I'm willing to lose. So from this $100, let's say I'm only willing to lose $20 off of it. I'm willing to lose $20. My risk is that I'm willing to lose $20. So what is my percentage risk? Someone? I'm willing to lose only $20 from my $100. This simple. $100 is equals, in short, this is what you're saying. $100, zile maths za primary, is equals to 100%. What about, hapa ndo question mark inafaa kuwa. Question mark shift. Question mark inakuanga gani sasa? Whatever. What about actually these are not about $20. What's my percentage? Dollars is equals to what? Cross multiply. Someone to tell us, if I'm willing to lose only $20 of my $100, what's my percentage risk? Trader Juma?
2% risk.
Yes, 2% risk. 2%. So my risk is 2%. So I'm risking only 2% of my account. How do we get to set these conditions? Come to this position tool, double click on it, or just click on it, right click on it. So then after right clicking on it, it will go to this, go to settings. But the easiest way, double click on it. So from this part, the only important parts in crypto, the rest are important to Forex, but I want you to know only two important parts, the account size and the risk. But in this situation, just know the size is not the size that we're talking about in crypto, that is leverage times margin. In this specific dialog box, size means the margin. So in this case, the amount of margin that you are willing to commit in our trade right here is $100. So that's what my account size is, my margin. Always know that it means margin right here, margin. So lot size, those are za watu wa Forex. So my only concern in crypto is this part right here and my risk. Only those two prices, my account size and my risk. Entry price, do not worry, it will automatically put itself because it's the condition of this position tool, long position tool. So it will automatically feed itself 0.99 and this one. So no wonder I'm saying my conditions, my only concern is this size and the risk. $100 is the margin, my margin. So I'll put my $100 right there. My risk, percentage risk in this trade is 2%. So I'll come and say, I'm willing to risk 2%. Okay? So, and I say, you can see it's in percentage. If you want in USDT, then you'll have this $20 as $20, like that. But to make it easier, just have it in percentage. So I'm willing to risk only 2% of my account and say okay, and you'll see it will auto update itself. Let me zoom in, you can see. So because I'm willing to lose 2%, it means if my stop loss gets hit, how much money will I have remaining in my account? Someone? Joseph?
$8.
$8. Let me, there's something I want to do here. Yes. This was wrong. You gave me a wrong answer. This is supposed to be 20%. If you've gotten that, someone, thumbs up. Oh, I'm doing this wrongly. $20 multiplied by 100 is equals to 2,000 divided by 100. It's supposed to be 20. It's supposed to be 20. 20%. No wonder nimeshanga why it's 98. So if I go to my position tool, my risk is 20%. I want to lose only $20 in this. So it's 20%. 20% of my trade. So you'll see if I now my take profit, if you can see this amount, it's quite small. Let me just zoom in. I want you to look at, if I move my cursor to this part right here, you can see that the amount, if my my stop loss is hit, the amount, you can see stop. If you can see that word stop, thumbs up. If you can see stop, thumbs up. So I'm having stop 0.00262 into brackets 0.87%, 262, then amount 80. So if my my stop loss is hit, then the amount that will remain in my account is 80, confirming that our math is correct. I remain with $80 in my account, meaning I've only lost $20. If you've gotten up to that part, thumbs up. Meaning I've only lost $20. So it has gone according to plan. It has gone according to plan. My condition was only to lose $20. So if my my stop loss is hit, my account will remain with $80, meaning I've lost $20. And if it goes to take profit, if it goes to my take profit, then what will happen? Let me just do the same. My account will remain with 308. So how much profit will I have made? Someone? My account, if my take profit is hit, my account will remain $308. How much profit have I made? Someone? Slide.
You'd have made 208.93.
Yes, 208.93. Because remember, capital was $100. It was $100. And now my account has 308. So to know my profit, I just take 308. It's 93 minus $100. So that makes a profit of $200 point something. Like that. But for all those conditions to be true, so that if my SL is hit, I only lose $20, and if my take profit is hit and I lose and I gain 208 point something as profit, I need to use a leverage that befits this condition. So how do I calculate this? Percentage risk. Remember, percentage risk is the amount that you're willing to risk in that particular trade, and in this case, my percentage risk is $20. So leverage, my leverage will be, leverage right here in this condition is equals to 20%. That's my percentage risk. Remember, percentage risk is the amount that you're willing to lose, divided by standard loss. So what is standard loss? Standard loss is this part right here. Let me just go back and control plus, we zoom in again. So in these conditions, remember on my stop loss condition, I had stop 0.000262 into brackets 0.87. If you can see 0.87%, thumbs up. If you can see 0.87, only Sly and Joseph, 0.87%, thumbs up. So that's my standard loss. My standard loss. Standard loss. So my standard loss in this case is 0.87. 0.87. Let me zoom like that. So my standard loss is 0.87. 0.87. Someone to tell us what our leverage will be now? Someone? Someone to tell us our leverage. Simple maths. 20% divided by 0.87%. What's our leverage? Someone?
Around 23.
Yes, around 23x. 23x. So you can see, you can actually use this is the best way to calculate. I see people guessing their leverages, and I wonder how they are doing that, because this confirms to you, you can actually use a high leverage while still protecting your capital. You're using a very high leverage, 23x, but at the same time, you're only risking 20% of your account, only 20%. And if you see 20% is a high percentage, just come to this part right here. and reduce this, you'll notice, let's with these conditions, we saw that our profit will be, we said it's 208 point something. Is that okay? Is that correct? 208, it was 308.93. So minus 100.
Yeah.
That was our profit, right? Our stop loss, our loss, if you hit stop loss, our loss will be $20. Okay? $20 like that. So you can see, you can still use a very high leverage, 23x, while still protecting your capital. You're still only losing 20% of your capital. And if you feel 20% is still high, just come to this, change your condition. Say I want to only risk 5% of my account, only 5% of my account. That is what I want to risk in my Binance. You'll see now the difference will be so high. So if I'm risking only 5%, the more you risk, remember you said crypto is more risk, more reward, but more riskier. More risk, more reward, more riskier. So if you see this now, you'll notice that if now I lose, let me zoom in. If now I lose, how much money will I have lost? Someone? If this trade goes against me and I take profit, how much will I have lost?
$5.
Yes?
$5.
$5. Why?
It's because the risk to may decide to risk only 5% of the amount we have in the account. I have in the account.
So 5% of $100.
Yes.
Which is $5. Yes, let's appreciate Juma. $5. But also, instead of doing all those maths, the position tool has done that calculation for you. It has shown you if we hit our stop loss, the amount that will remain in our account is $95. If you can see 95, thumbs up, is $95. So it means our initial account, but our account size was $100. So 100 minus 95, $5. But if I hit take profit, how much profit will I have made? Someone? If I hit take profit, how much will I have made? Sly?
You'd have made $52.23.
How did you arrive into that conclusion?
Because you had your initial capital was 100, and then now at the close of the take profit you have 152. So
Great.
52, yeah.
Yeah, so you minus. So you can see the differences between these two. Let me now zoom in. The differences between these two. The difference is now that our risk, if I hit my loss, let me just use another tool. If I hit my loss, I will have lost what? Only $5. If I hit my take profit, then I will have made 52. How much was that? 52.23. $52.23. Let's look at what my leverage will be. So my leverage will be, what's my standard risk? What's my standard risk, someone? What's my standard, my percentage risk rather, sorry.
5%.
5%. Great. 5%. Remember, that's what we fed in here. That's what the amount I'm willing to lose. You can see we fed that here. The amount I'm ready to risk in this trade is 5%. So 5% divided by my standard risk. I will zoom in, then someone will tell me what my standard risk is. What's my standard risk? Let me just zoom in. What's my standard risk?
0.87.
0.87. Great. So let me just zoom out again. So divide by 0.87 again. So what's my leverage?
5.7.
So my leverage is 5x. 5.7. So around 6. Let's just say 6. So it's 6x. So you can see how the same setup, same capital for both position can determine different profits. We are having the same account size, we are having the same setup, but you're going to have different profits and different loss. Our P&L will be very different. In this case, if my loss is hit, I lose $20. But in this case, if my stop loss is hit, I lose only $5. So if my take profit, I'll gain $208, but if my take profit in this scenario will be $52. But my leverage right here is 6x for my conditions. And my leverage right here is 23x for these conditions to be met. So high leverage, high risk. That's what we mean by high leverage, high risk. So, and with that now, we have all our conditions now. Depending on which condition you'll use, you can remain with 5x if you're risking only 5% of your account. And if you're risking 20%, then our leverage right here will be 23x. 23x. Whatever. Use this plus and have 23x like that. And you can see it is even giving you reasons or a warning. Selecting high leverage such as 10x increases your liquidation. High leverage, high reward, but also high risk. If you have understood that concept, thumbs up, of how we calculate those two things. And you can see you're talking about percentage risk here, how much of your amount you're willing to lose, but the standard loss, do not even worry about this English. The distance between your entry and whatever, do not worry. Just know that the standard loss is this one that is given by the position tool. We're not here to test how much we know English. We are here to understand the concept. So that this one that is given right here, that's your standard loss. So that's basically how we calculate leverage. If you have any question, thumbs up. Tomorrow we're going to have day 2 of this trade. Day 2 of futures, so you're going to have that tomorrow. Any question? Joseph?
Not a question. I have been the one of those who guesses leverage. Now I know I will not guess again.
Pardon?
I have been among those who are guessing leverage.
Yes, you're just guessing leverage in accordance to the grid that you have.
Okay, I usually say if I want 100% on take profit, I gauge my leverage according to the take profit, not according to the risk.
Not according to the risk. And that means that you can actually lose a lot of money because you have not calculated you have not committed your percentage risk.
Yes, now I'll use the best way.
Yes. So even if you see someone has used 80x, do not worry. Someone who is using this formula might be using 80x, but the risk that they are willing to lose on that account is only 20%. You've seen from this perfect example right here that I'm using a very high leverage, which is 23x. But the amount I'm losing on my account is only $20. Only $20. But someone who is guessing will actually use a leverage of 23x, and it means they are actually risking the whole amount on their exchange. So that's how you calculate leverage. Don't just guess your leverages, calculate them. So you can see you have different leverage. Right here was a 4x used, this one was a 10x used. And you can also, these are basically pictures to show you how different exchanges look like. So on Binance, it looks like this. If someone shares with you, it looks like this. But on other exchanges like BingX, it looks like this. On MEXC, it will look something like this. On Bitmart, you can see it looks something like that. Any question? This is the last part that we'll do tomorrow. Today I wanted us to just basically talk about the basic things on trading futures. Any question? If the concept up to that part has been understood, thumbs up. Okay, great. So see you guys tomorrow. Juma, you have a question?
Oh, I don't have a question, but I have an addition about the order blocks and fair value gaps. So if someone is interested in using those OBs and FFG.
Yes.
FFG almost almost it happens when an order block happens. Like ukiona order block, there is likely that FFG still iko hapo. So if someone is using those things for trading, those tools or terms, then end up backtest backtest about OB and FFG. They almost happen at the same time, mostly. Yeah.
Yes, that's a good observation. Also, I noticed something just to advise anyone who has never done technical analysis. Just go take one pair, let's say BTC USDT. Actually, it's the best pair to start with as a beginner. BTC USDT, because it's more stable. BTC is more stable. So start with that and master how that chart moves. You'll notice, I'm very sure Juma has noticed that, because the more time you spend on the charts, the more time you'll see these patterns repeating themselves. So where an order block is, the probability of an FVT happening is much higher. And these things, you'll just understand them or get them if you spend more time on the charts. And to reduce more confusion, don't move to any other coins. Take one pair and make sure you understand how that pair works. And with that, I'll end this class at this juncture. We see each other tomorrow. I know we normally don't have classes on Friday, but because I wasn't there yesterday, I'll fill it in tomorrow. So otherwise, guys, have a good night. Bye bye. See you tomorrow. Good night.
Good night.